Everybody, Luke Gromen, FFTT. Hope everybody had a great weekend. It's a beautiful weekend of weather here. I hope you all had a chance to enjoy it, if it was nice by you as well. Going to jump right into the questions. From Earl, what month do you think the Fed will pivot? August. I've been saying by the end of 3Q22 at the latest. What has happened in credit markets over the last couple of weeks has brought that forward for me. So that's what I think at this point. From David, recession seems guaranteed. When the Fed pivots, can more QE levitate stocks in such a recession? I agree that I think a recession is now fait accompli. And yes, I do think that more QE will send stocks higher. From PA, what if the Fed is willing to punish the U.S. economy in order to save the dollar? Is there no way they could slow walk the tightening while a new administration basically cuts government spending? In my opinion, it's sort of what they're doing, what the whole point of this tightening really is, I think. When you talk about fighting inflation, you're really talking about defending the dollar. So I think they're doing that, but in my opinion, they're not willing, and they will never be willing to punish Washington, D.C. They'll punish regular America, they'll punish the economy, but they won't take it so far as to punish Washington, D.C. And by that, I mean, if we have a stronger dollar from tightening and a recession, you're going to have a shortfall of foreign buyers of treasuries. You're already starting to see this in the data article out today. Japan selling treasuries due to where the dollar is, due to the after FX hedge yield on U.S. treasuries relative to other sovereign debt out there. And so if you have a shortfall of foreign buying of treasuries, you either have to do one of three things. You either have to cut spending in a recession at the federal level, and with federal government 22% of GDP, that's going to make the recession a lot worse. The deficit's a lot higher non-linearly. Or you're going to see yields on treasuries up in a recession, which is highly unusual, and again, will worsen the recession given the interest rate sensitivity of tax receipts, the U.S. economy more broadly. Or the Fed buys it with QE. And the first two options really amount to the Fed standing aside as a death spiral effectively, with U.S. debt to GDP, U.S. deficits to GDP this high, where you're just going to have higher interest rates, higher dollar, lower tax receipts, bigger deficits, higher interest rates, higher dollar. Wash, rinse, repeat until either the system collapses or the Fed does what they did in March and April 2020, which is go into expand their balance sheet much faster. From Mark G. Luke, your premise that the U.S. deficit will rise materially is predicated on much higher interest rates, much higher interest expense. But with higher rates, higher rates will take quite some time to reflect in higher interest expense. Even with lower receipts, could the Treasury not run a medium-term deficit and the Fed not need to pivot? The rates are really a small part of it, directly speaking. Historically, the dynamic is really that historically in recessions, last four recessions, we have seen deficits as a percent of GDP rise by 1,000 basis points of GDP in the COVID, which we'll set aside, 800 basis points of GDP in '08, 500 basis points of GDP in '01, and 300 basis points of GDP going back to '91. So I've not been using the COVID 1,000 basis points of GDP deficit increase, although it may be apropos given how high debt levels are across the economy and around the world. But what we're saying is basically, let's just use the middle case of 500 basis points of GDP within the first year of a recession in terms of widening out the deficit as receipts come in sharply lower and counter-cyclical payments rise with unemployment. So 500 basis points of GDP, that's about a $1.1 trillion increase in Treasury issuance at a time where the Fed's still theoretically selling treasuries. The Treasury is still selling treasuries to the tune of $1.2 trillion, right? So the deficit would go to $2.3 trillion. Fed's selling treasuries. Foreigners are selling treasuries. We are talking about the effective supply of treasuries going to $3 or $4 trillion. It's unclear to me in a global economy of 80 trillion in GDP, growing 3% in a non-recession, that's 2.4 trillion of GDP growth against 3 to 4 trillion of net treasury issuance, effective treasury issuance. Who the buyer is at current rates. And that's assuming global GDP is still growing. You start shrinking global GDP, that number gets even more backwards. You get the stronger dollar flight to safety, less foreign buying. these are the dynamics where there's just this fundamental supply-demand problem for treasuries that has never existed before. Debt wasn't this high, deficits weren't this high, not as much offshore dollar debt that required people to sell treasuries to service dollar debt. There's all these factors that have never happened before, and so that's really the dynamic. Now, could the Treasury I think has $500 or $600 billion in the Treasury General Account, or TGA. Could they run that down to buy themselves a few months so they don't have to increase issuance? I think they can. I think the market will start to see through that pretty quickly, because obviously it's only a finite amount of money in there, and they don't like to usually drain it below certain levels, but they could in the short run. So that maybe is something that could push out the pivot date where I would be wrong. From TF, what should ordinary people without a ton of money be doing to prepare themselves to best weather this storm? I think you want to be liquid. I think you want to be unlevered as much as possible. And I think you want to be balanced. What we're going through, this first bursting global sovereign debt bubble in 100 plus years, centered in the West for the first time in 100 plus years, with peak cheap energy, peak cheap commodities for the first time ever. This is the most frightening macro setup I've seen in my career doing this 27 years. So it is not the time to be being brash and being hyper aggressive. I think where we're getting to quickly is like the end game. I think is pretty crystal clear. I think is highly likely, which is face peeling printing, probably through some version of yield curve control. It's already restarted in Japan. They're moving a little towards it right now. We're talking about it in Europe. I think it's going to come to America as well. That's something that's good for gold. It's good for Bitcoin. It's good for commodities, equities. However, it's critical as a quote unquote ordinary person in these markets to understand that this is a political event. This is a political process. So between here and that end game, we're already seeing the mind-boggling volatility that has happened, and it will likely continue to happen. It's a highly political process of what is effectively sovereign default in the West, likely to be done via sustained high inflation. But again, that doesn't mean we can't go through 6 months in time like we've just had, where we're seeing risk off in bonds and stocks in a way that has not happened in at least 50 years. I expect these types of, this hasn't happened in at least 50 years events to become increasingly common. And when we talk about balance, so you want to be unlevered. You want to be borrowing a bunch of money and buying a bunch of assets. You want to be conservatively financed. I think you want to maintain a higher than usual liquidity position, so more cash than usual. When I talk about balanced, I always go back in my mind to the Jacob Fugger, the richest man in history as a percent of global GDP, supposedly, and how he generated and passed down generational wealth with a very simple model: 25% cash, 25% gold, 25% stocks, 25% real estate, rebalance when one gets out of whack with the others. If you want to inject a little Bitcoin on the gold part, if you want to inject a little bit of bonds with the stocks part, or some commodities with the stocks part, go for it. I think there's different things you can do in real estate, but that's what I mean about balance. That is balance. So from Dale, why did oil drop so severely last week? It's a good question. It was one I was asking myself and other relationships in the business over the weekend. The short answer is I don't know. There were rumors of peace talks. There were potentially the Biden export bans, some concerns about the impacts of that, the fuel export bans that the Biden administration is now talking about, essentially out of political desperation. Demand fears as maybe the economy is slowing down, although the highway data, the fuel usage data in the U.S. at least, don't seem to be supporting that, at least yet. Just extreme positioning. It doesn't take a whole lot. If everybody's really bullish on energy, and I know we are, it doesn't take a lot to get it to sell off a little bit in the other direction. So I don't really know. Those are some of the thoughts that I had heard over the weekend as possible explanations, but I don't have a great explanation for you, so I apologize. From Jeff, here's my question. If you were right, but the Fed is either in denial or doesn't get it yet, what will break as they get it wrong? Or perhaps more concise, how long can the Fed keep pushing rates up before they're forced to relent? What are endpoint conditions? The stuff that'll break is the stuff that's already breaking. Bitcoin first, stocks, bonds, mortgages, treasuries, high yield. And really it's stocks, high yield, mortgages, foreign sovereign, treasury market, Housing, you're starting to see inventories build. Tax receipts, which are starting to get weak in May, although it's a noisy data series. Everything we're seeing is what I'd expect to see breaking if they're starting to make a policy mistake on the downside. So I think they really want to see oil and gas break. I think they've effectively been co-opted into the geopolitical fight against Putin and Russia. I just don't think they're going to be able to get oil and gas down a whole lot without doing critical damage to the U.S. and Western economies more broadly. Multiple questions about Powell's comment late last week that rapid changes in the global monetary system may affect future international role of the U.S. dollar, and what my thoughts were around that. Here's another one I don't know. It's a very odd thing for the Federal Reserve chairman to say. I'm not sure if it was just a boilerplate warning type of legalese, or if he's hearing something or being debriefed on something. I mean, Russia could certainly do something in retaliation that would have that effective impact, right? They could shut off the gas taps to Europe. They could say, that's it, we're only taking gold for our gas. We're only taking Bitcoin for our oil, in theory. Saudi could do something similar. Hey, we're now pricing oil in yuan and settling effectively at least some of it in gold. That I think a Saudi announcement about yuan, a Russian announcement about gold, would probably fit into the rapid changes in the global monetary system. But until I see something else, I just have to believe it's probably just boilerplate. I don't know the context of the question. And then finally, two questions that were sort of related. Could you explain why 10-year bond yields rising to 3 to 4% is bad and will force the Fed to turn if a few years ago they were much higher? Italy and Germany 10-year yields were double just 10 years ago. Why will rising yields force the ECB to turn too? And Luke, could you please talk about the mounting sovereign debt crisis that now appears to be understood more broadly? What you believe the awareness, acknowledgement, and response of the Fed may be in coming weeks. So I think a key difference here is inflation's finally here, right? Inflation's here, and that is problem one. And then secondly, the debt levels in the West are much higher post-COVID. And so the issue is the amount of rate hikes needed to stop the inflation is likely to bankrupt the sovereigns because the debt's so high. And so I think I agree there is greater awareness. I still think it's in the minority. It's not mainstream yet. There's still a lot of mainstream policymakers out there that think the U.S. can pull a Paul Volcker to fight inflation. But I do think an aha moment is coming in the next couple months when the U.S. and the global economic data, I think, have a chance of getting bad enough where inflation's not coming down that fast, that suddenly there's this recognition that they can't tighten much more, and that I think that is I think that will be reinforced by the U.S. Treasury seeing tax receipts come in below expectations for several months in a row, where they have to come out and say, well, we weren't going to issue much in the second or third quarter, but now we've got to increase Treasury issuance because tax receipts are coming in below expectations. And if you increase Treasury issuance into what we're already seeing is this suboptimal U.S. Treasury supply-demand dynamic, which is part of the reason why yields are rising, that may also really be an aha moment or a forcing factor where the Treasury market, sovereign debt markets more broadly get dysfunctional. Again, arguably we're already seeing that a bit in Japan and Europe in the last couple of weeks. It's strange credulity, I think, if we're already seeing Japan and Europe, that the Fed won't be forced to follow. So I think we're seeing a lot of the signposts of a breakdown or an acceleration in the global sovereign debt bubble bursting, and that's part of the reason why I think the Fed's going to be forced to pivot by the end of 3Q22 at the latest, probably earlier. So with that, I'm going to finish up for today. I want to thank everybody for joining me as always. If you're interested in what we're up to, you can check us out at FFTT-LLC.com. Learn more about our different product offerings, both institutional, mass market. Learn more about tree rings, which is quick 10 most interesting things. Summary about each point and why it grabbed our attention, how it fits or doesn't fit with how we are and we're seeing the world going into learning that information. So as always, thank you very much. Everybody have a great week and look forward to talking with you soon. Take care, everybody.